This company just told investors that it'll lend in more than 60 billion in new orders, and the stock is still sitting around $31 as of right now. This is one of the strangest setup on the market right now, which is a super microcomputer. Their ticker symbol is SMCI. That builds the actual machines that runs AI. Currently, it's trading around 16 times of earnings price ratio with a 20 billion market cap as right now. So why is a company with a record order book priced like a market does not believe it? So we're gonna go ahead and take a look. All right, so the latest news. So there's four things. So four things are moving with the stock right now. First, that 60 billion. In July, Supermicro said that it took more than 60 billion of new orders in a single quarter, the biggest backlog it has ever had, and it will fill that over the coming quarters. Second, the profit margin is snapping back. Early fourth quarters numbers shows growth margin of 15 to roughly 17%, way up around 10%, which is recently. Third, the full report lands on August 11th, just 2 days from now. So everything I'm saying is right before the real number really hits. And fourth and lastly, the reminder of why people are nervous. So back in March, one of the co-founder was quote unquote indicated over AI chips sent to China, and he stepped off, the board, quote unquote. All right, so the 30-second vision. So Supermicro builds the physical machines that runs AI, the servers and the full racks. Sales are exploding, but the profits on those sales is still thin, and the company is burning through cash to keep growing. On top of that, it is still rebuilding trust after the accounting scandal. So the four things that holds in your head, what it is, an AI server maker tight with NVIDIA. The big thing now is over 60 billion in order. And the big thing now is that 60 billion order and margin is still recovering. So in reality, the money sales is soaring, but profit is still quite slim while the cash is going out the door. And the real tension is that the growth is clearly unreal, but the trust and the cash are the real question that really leave a mark for them right now. All right, so how does Supermicro actually makes money? So it sells the box, so like servers, storage, GPU systems, and full racks that go straight into AI data centers. Its edge is speed. So when Nvidia and AMD ship out a new chip, Supermicro is usually the first one to have a working system built around it. So they already have the ecosystem and everything because everything is modular, like building blocks. So it also does its own liquid cooling, which matters a lot when you pack many chips in there. It really heats up. And the customers are the names that you know. It built half of the servers for XAI alone. It supplies Tesla and is growing from four huge data center clients, and they're working towards like the six to the eight. All right, so the numbers. So now the numbers is this is where it gets interesting. So revenue went from 15 billion in 2024 to 22 billion in 2025. That is a 47% growth in 1 year. But look at the profit. So the net income actually fell from 1.2 billion to 1 billion. So it sold more and made a little bit less, which, doesn't really make sense. But to take a look into it. So that's really the squeeze. Then at the most recent quarter, on the right where I have the chart, 10.2 billion in single 3 months. This is a company operating at a completely different scale than it was 2 years ago. It's just not keeping much of the numbers of each dollar. All right, so we're at the part that kind of like scare people in a way. So look at the cash. So in the most recent quarter, the businesses did not bring cash in. They sent 6.6 billion out. The capex, the money spent on buildings and equipment, was tiny by comparison. So the free cash flow and the cash it actually keeps was deeply negative, around 6.7 billion. Why? I assume it's because to fill those giant orders, it has to buy like, piles of parts and wait to get paid. And that ties up an enormous amount of money. So over the course of like, almost a year, operation used like 7.6 billion alone. And that's the hard truth. So in reality, if the company grows fast, grows too fast, the more cash it really needs up front. So it's really kind of common sense. So where does the money actually go? Well, definitely not going to us and the shareholder. There's no dividend and there's no buybacks. So every dollar, goes back into growth and it is not going to buildings either. CapEx is the only about 130 million a year, which is not much at all, which at this scale is basically, a rounding error. The real story is inventory. There is around 11 billion tied up in parts sitting in the pipeline, waiting to become, finished servers. And to fund that pipe, the company has to line up a plan, a 7 billion capital raise. That is still the engine, and the rest is in one picture. All right, so let's zoom out real quick. Let's look at the macro and geopolitics side. So, what is really helping for them? So, it's definitely the AI build out. The big cloud companies keep pouring money into AI data centers, and Supermicro sells the gear that fills them. What is really hurting, or at least adding the risk for them, is really leaning towards and heavily relying on Nvidia. So if Nvidia chips are tight or late, Supermicro will also be impacted. Then there are, the quote unquote China export rules, tighter controls on where the advanced chips can really go to. And if they go to somewhere else, it can be a real risk and a real scrutiny, especially given that it didn't come in. And the trust is overhang. The old accounting mess still shapes how carefully investors price this stock. Alright, so as for the competition, so who are the main competitors for Supermicro? So it's basically mostly like Dell's and also HP. Both of them are quite big, really big actually. Both are really pushing hard into AI servers, especially Dell. The main advantage that Supermicro has is that it moves faster and is genuinely strong in liquid cooling racks. So this is their niche that they have. But their weakness is that just switching to a competitor, it's not that hard in that field. And the hardware itself is close to commodity, which is exactly why margins are extremely thin. And here's the twist. So his own governance trouble handed Dell and HPE an opening to grab share while Supermicro was distracted. All right, so they are for risk. So plainly, one of them is very thin margin, which is quite high of a risk. Gross margin near 10% leaves almost no cushion if prices drop. Second, the cash burn is also quite high. This growth is only works if outside funding keeps flowing in. Third, governance and legal probably rank like medium between the accounting history and the just chip smuggling indictment. Headline risk, is quite real. And lastly, the fourth one is customer concentration. So I'll say that will be medium. A handful of giant clients drive a big chunk of the revenue. So if they happen to lose one, it'll definitely hurt them. So there are three ways, to play it out. So the bull case is that 60 billion backlog turns into a real revenue, margin holds above 15%, and Supermicro becomes the default company you'll call it like to build all these data centers. The neutral cases is the revenue keeps growing, but the thin margins and steady cash burn keep the stock, stuck in that range, going nowhere fast. Lastly, the bear case is margin slips again, raising money gets even more expensive, and the old trust question, will come back again. So it's the scandal price in at 16 times earning price earning ratio with a 60 billion backlog. The market is clearly torn. The growth is real. Trust the question. But yeah, this is basically the breakdown that I have for Supermicro. All right, thanks. Bye.